And good afternoon. Welcome into Market Talk for Wednesday, November 18th, 2020. I am your host, Jesse Allen. Great to have you here with us. MarketTalkAg.com. That is the place to find us on the web. Facebook, Twitter, Instagram. It's all Market Talk Ag. And on your favorite podcast sources, including Spotify, Apple Podcasts, iHeartRadio, Amazon and Audible, and so many more. Let's take a look at this market trade today. Another good day in soybeans. We keep knocking on the door of that $12 market futures, it seems like. But let's get some thoughts on that. Let's bring in our friend Mike Zuzolo with Global Commodity Analytics is our guest today here on Market Talk. Mike, how are you?
Doing great, Jesse. Thanks for having me back, sir.
Hey, appreciate you being on the program, Mike. And let's dive into this market trade today. We had a great day yesterday in soybeans. Another modest uptick today, 11.75 at 3/4 on that January contract at the close. And we're knocking on the door at $12 in this futures market, it looks like, Mike.
Yeah, we're trying to get up to that 1208.5 high from June 2016. I think one of the big things that I'm seeing this week versus when we talked last week is the fact that bean oil is the leader to the upside instead of the bean meal. And, the key with this meal market, it's not unlike the wheat market in terms of you typically would want to have the meal as your leader to the upside because that is your feed side of the equation. Bean oil is your human consumption, vegetable oil side, and it's real elastic. And what that means simply is that as prices go up, people start dropping off and stop buying as much, because they're going to feel it in the pocketbook a lot faster, especially in the emerging markets. And so strategically, I think that you need the meal market to come on board really quickly. We've had new highs in soybeans, as you said, Jesse, but we have not been able to get above those 2018 highs in soy meal. So it's a real disconnect we're starting to see where the meal isn't even at a 2-year high and can't crack $400 a ton. So between the meal and the wheat, I'm a little bit skeptical of this market. I would say one other thing about this soybean market. We're in the middle of the battle right now between the supply bulls and the weather, and them starting to talk negative carryover for the United States before we go into planting because of the South American weather issue. Having said that, though, South American weather is looking wetter in week 2 on both of the major models, both of the major weather models. So I'm telling clients and subscribers right now, let's really watch carefully to see how we close the week out versus how we started the week out. In other words, can we hold on to all these gains, given the meal, given the wheat, and given the weather?
And, you bring up a great point there, whether or not we can hold on to these gains through the end of the week with all those factors. We saw the big pop after the reports last week, and then we couldn't hold that through the end of the week. And now we're seeing a little bit of an upswing again. And I would agree with you. I think it's a question of whether or not we can hold this through the end of the week. And, if I'm a producer out there looking to maybe market some soybeans, it might be a little caution if I'm waiting to go up to $12 possibly.
Yeah, you and I talked last week about getting in the hedge side of the back end, like new crop beans getting up to 1040, 1050 now in the November contract. Nothing wrong with coming back in and buying back into the March and buying like a $12 March and selling a $13 March. Earlier this week, those were running about 25 cents plus costs. So you're essentially saying, okay, I'm going to lock in 1050 futures, and I've got 75 cents profitability potential between now and February. And I think that's a really nice strategy. In fact, as we go on the air here later in the week, I started to do that in the new crop corn as well. Made my first 21 sale in corn at that 408, 410 level, stepped back in and got a March 450 call bought for part of the sales that I made, and those were running around 15 cents. I still think, Jesse, that the corn has much more upside percentage gains-wise than the soybeans do, especially given what the wheat's been doing here with it correcting, roughly 35 cents off of its highs here in the last 3 weeks. So I still like the corn a lot more, and I would not be surprised to see a March 450 call go in the money, especially if we stay dry in South America.
Yeah, and you mentioned corn. Let's talk about that, Mike. We kind of hit that resistance level, and we pushed through it just barely today, and we held there. We got past and got to 425, almost 426 on that December contract, 430 in March. I mean, corn looking pretty nice after today.
Yeah, it's getting overbought. We know the funds are super long, but you're right. We did what we needed to do as far as taking out last week's highs. And there's not a lot of resistance after 435. You get 435 cleared in December or old crop lead month futures. You look at a daily or weekly chart, there's really very little resistance until you get up to around that 450, 460 level. So you're at a pretty critical point right now, and it's not unlike what we did when we busted above 1040 lead month beans. We had not been above 1040 on a monthly close until October, and I believe it was all the way back in 2016 that we had not done that until this past month. So I think the corn is maybe following about 30 days behind the beans, especially given what the wheat's been doing. And while the weather models are getting wetter for the hard red wheat belt and getting wetter for the soft red wheat belt, and conditions went up another point this week, I still think the corn needs to keep its acreage base intact. 1050 new crop beans, I'm already hearing it right now by clients and subscribers that have called in that they're really looking at putting a lot more beans in just from a risk reward standpoint.
Yeah, and you mentioned the wheat market as well, and that's kind of been the driver that we're watching here for a few different things. That weather market just continuing to be that focus, and you already alluded to it. It just seems like overall there's some cause for a little pause and a little resistance maybe in some parts of this commodity market, but for the most part there's a lot of optimism out there.
Yeah, there is. And what we're doing right now is kind of the exact opposite of what we were doing the past 3 years. We were looking at only the poor demand and not really looking at the supplies, or looking at only the big supplies and not the strong demand. And what we're doing right now is really looking at the weather and the tighter supplies and not really thinking about the demand at this point. And some of the energy data that came out this week would suggest that we're running about 9% below year over year for consumption of refined products. Now, having said that, we had talked about the heating oil and the distillate market, and the fact that I wanted to lock in some diesel. I'm glad we did that because we lost more stocks of diesel this past week in the weekly update. But energy numbers are starting to show weaker demand. The livestock sector is starting to show some weaker demand. And we're starting to see an issue where the wheat market, and bringing it back around to the wheat kind of full circle, it's our best gauge for the demand side, because I think it's the one that, we're just barely above last year for export commitments shipped out year to date, while the the beans and the corn are running 76, 78% ahead of last year at this time. So I really think the wheat is the canary in the coal mine for the demand. And if it doesn't want to go any higher here and the rains come in on the hard red wheat belt, I think it will really probably tap the brakes and give us some potential for a greater correction. I'm still on track with the idea that the month of November is probably going to give us the most likely scenario where we have the high in the soybeans, especially if we start to see some rainfall.
Yeah, and you bring up a great point that I was going to go to next. Typically end of November, December, the holiday season, there's not a lot of activity in the marketplace. Typically, traditionally, things can get fairly quiet. Harvest is done. We're going through the holidays and the doldrums of winter and everything else. So, I mean, for where the market is at right now and the movement we are seeing, I think it's got to be a welcome sight for many folks to see a little bit of a movement still in this market when it's traditionally a quiet time of year.
Yeah, and I think I'm not trying to call the end to the trend, but I think we just need to stop going up parabolically high and with a sharp straight angle up. We really want to get that demand base back, and you do that with a 35, 45 degree trend line support being hit. And that's what I like so much about the wheat. I think the wheat is the best barometer for the demand, in part because it's looking at both supply and demand right now, and it's not going up the flagpole like the soybeans and the corn are, trying to ration demands severely. And I think that's going to be good in the long term, that the wheat base holds, because we still have some of the lowest acreage in 100 years here in the United States, and we still got a lot of problems in Russia and Ukraine. The global wheat market is nothing like it was 3-4 years ago, even though USDA has given us such a massive world ending stocks number and still trading, around 42% world stocks to use ratios. We still have a lot more problems out there than we have a big crop potential out there. So I'm encouraged that as we go through the winter time, we still have the wheat as the supportive feature for the overall trend.
And I think overall, to kind of summarize our grain talk here, if I'm a producer and I haven't necessarily jumped into anything yet here with where prices are at, if I have some room to take some profit, it seems like now might be the time to maybe dip your toe in a little bit at least.
I think so. I mean, I'm getting client calls from Indiana, especially from the western edge to the eastern edge. They're getting 450 cash corn right now, or 450 Jan delivered corn. That goes all the way to Decatur, Illinois. And so you're getting 445 to 450, whether you're in Lafayette, Indiana, or Decatur, Illinois, and that goes all the way over to the Ohio-Indiana border practically. I don't think you want to turn that away. Why? Because COVID hospitalizations are now hitting new peaks, and we're literally 30% higher than we were back at the previous peak back in March, April. And what you and I talked about last week about these shutdowns and these lockdowns, they're happening, and they're happening at a rapid pace right now. And I'm fearful, based upon the analysis and some of the scientists that I follow, that we're only going to see it get worse between now and Thanksgiving in terms of more areas putting in mandates that people probably won't follow. But by the same token, it keeps the livestock market and the demand side as a buyer's market, not a seller's market. So I think corn and beans probably need to join up with the wheat a little bit more and come back down to earth a little bit, especially if those rains start to fall in southern Brazil.
Well, Mike, you mentioned COVID. I think that'll be a good segue into this livestock market. We're starting to see, demand worries there, even more so with more lockdowns coming, more shutdowns, et cetera, et cetera. I know a cattle market down on the futures side today, we saw some activity in the countryside around 110 in Kansas, Nebraska, Texas. We've countryside, we've been selling that 110 mark, it seems, for a while. We're still stuck in this sideways range, but like you mentioned, it seems like there's maybe a little worry starting to creep into this cattle market.
Well, on the other side of that is a lot of the drive in this cattle market seems to be that box beef price, and the choice box is jumping, $633 at midday on Wednesday, if I remember correctly. I mean, that's the highest price we've seen since April or May, Jesse. And I don't think the market can tolerate that, because typically what happens is that box beef price is essentially your hamburger price 30 days from now. So we don't want higher retail prices right now as we go into massive lockdowns, and restaurants can only be at 50% of capacity. You can't put anybody outside as the weather gets cold. And I'm not trying to paint too negative a picture, but 110 is not a bad price for fat cattle. And I've continued to hedge the back end markets at that 118 level, because as we talked about last week, USDA is no better than 110 for cash steer prices all the way going through the second quarter. So if you can get $8 better than that in the futures market, that's a real good risk reward, because if you're wrong by selling 118 April, then your cash should start to migrate up towards 118 as we get into springtime. I don't think that's likely, but I'd love to watch that hedge come together.
Yeah, and we think about it too with possible shutdowns coming, and folks, they don't want to pay higher prices at the grocery store, but there might be a lot of folks who start stocking up again.
Yeah, there's a hoarding function, right?
Yeah, and I wonder how much that's going to impact the livestock markets, cattle and in hogs.
Here's the key, I think, for that, and it's a great question, because I don't think anybody's talking about it right now. But at the end of December, between 11 and 15 million people here in the United States are going to lose those benefits from the fiscal stimulus that we did back 3-4 months ago. And if we don't have something to lay on top of that before the end of December, you're not going to have that kind of grocery store spending that we've gotten used to. And you're going to see people really buckle down with how they spend their grocery dollar. And that's a key element to the meat market, especially the beef sector. And as we talked about in the emerging markets, if COVID starts to jump again and people go to the hospital in India and in Malaysia, you're going to start seeing them really not dial into the vegetable oil prices that are going to be higher priced by the time we get 30, 60 days down the road. So the point of this whole segment to me is we've talked a lot about supply the last 3 months because USDA and China's demand, but we really need to start talking about the demand side from a different perspective and bring those two together.
Let's go to hogs a little bit, Mike. And the pork cutout values holding steady, but it seems like hog prices sold on a live and carcass basis continue to slide day by day in this hog market. And mixed futures trade today. What are your thoughts on where hogs are at right now?
Well, I think we're underpinned in hogs right now, Jesse. I think we'll figure this out in the next week or two, whether I'm right about that, especially going into Thanksgiving, because we're in that major Christmas seasonal and Thanksgiving seasonal where we've gotten used to buying a turkey and getting a free ham as a result of that. But we've got the cash index still sitting around 70, these futures at around 65. So you've got a cash support level there. So if the cutout holds firm, then the cash index should start to attract maybe a little bit more buying by the funds as we get into this more positive seasonal. I also think the African swine fever in China is not getting taken care of nearly as much as they're promoting it is in China.
Mhm.
And I think if that continues to show up in the form of better weekly pork export sales, we'll continue to see the foreign competition and the fight for the domestic meat market here. So I'm more of a solid belief that the hogs are fairly priced right now. I've also been told by some clients that PRRS is starting to break again, and this is the worst time of year to have it break because it's kind of like flu season. It's going to be extremely hard to control. We're going to have to watch for that because if we have a big PRRS outbreak, that could really limit some of the production numbers as we go into Christmas, and those are supposed to be some of our bigger numbers.
Yeah, it'll be interesting to see, especially with PRRS, if that manifests itself, and of course African swine fever and just everything in general. It seems like those are all major factors to consider, and I agree with you. It'll be interesting to see the next couple of weeks here at Hogs how this all plays out. So, Mike, any other final thoughts on the marketplace today? I think one other question I wanted to ask you for sure. A lot of people have been tying the dollar to the markets lately. What are your thoughts on the dollar, and then any other final thoughts?
Well, the Chinese currency and the Brazilian currency versus the dollar is really what to be watching. It's not as much about the dollar index right now. I think that will come later, Jesse, as we get a president-elect that we know is going to be the president in January. That's probably where the dollar index will come into play. But right now, the currency traders and the grain traders have really been playing the dollar against the Chinese currency. And I can't stress to my clients and subscribers enough that between the Brazilian real and the Chinese yuan, that is a big reason why we've had this kind of a rally in the soybean trade and in the ag trade in particular. And if that starts to unwind itself, that's going to be a real issue for sustaining these kind of price levels. And you're going to need to feed the bull with weather more and more and more and more. We're really getting into a more singular market, especially if we lose those currencies.
Sure. Any other final thoughts for today, Mike?
That'll do it. Thanks for having me, buddy.
All right. I appreciate it. By the way, if folks want to reach out to you and get a little help with their marketing with Global Commodity Analytics, what's the best way to do that?
Best way is to go to globalcomresearch.com. When the globalcom's got 2 M's. And if you want to talk specifically, just give me a call after the market closes someday, 866-471-2588. It'd be great to talk to you and help you in your marketing.
All right, my friend. Hey, great to catch up with you as always. And we'll talk again soon, Mike. Appreciate it.
Thank you so much. Appreciate it, Jesse. And I do need to say, since I talked about some specific recommendations, commodities involve substantial risk of loss. Don't forget that.
Yeah, that is a great point. Mike Zuzolo with Global Commodity Analytics, our guest today here on Market Talk. And thank you for tuning in with us and listening in. MarketTalkAg.com is where you can find us on the web, on Facebook, Twitter, and Instagram as well. This has been the Wednesday, November 18th edition of Market Talk. I'm your host, Jesse Allen. Have a great afternoon.